Welcome to the XFO Intelligence podcast. Today, we go beyond the headlines to examine one of the most important structural shifts of our era, the global wealth transition, unfolding in a world moving toward a more multipolar financial order. Recent geopolitical tensions, monetary policy changes, and debates over the future of dollar dominance have triggered intense public discussion about inflation, currency stability, and wealth preservation. In short-form commentary, these developments are often framed in extremes. Some describe them as evidence of an imminent collapse of the existing order. Others portray them as a coordinated extraction of global purchasing power. But the reality is more nuanced. The international financial architecture is not simply breaking apart, it is adapting. And to understand this transition clearly, we need to move past binary narratives and focus on measurable structural drivers, observable thresholds, and practical adaptive strategies. Let's start with the mechanics behind the headlines. Geopolitical friction in the Middle East absolutely matters, but not in the simplistic way many commentators suggest. Its primary economic impact flows through energy markets and supply chains. When instability threatens major maritime choke points or disrupts trade routes, risk premiums rise, commodity prices move higher, and those costs filter through the broader economy. A sustained increase in oil prices does not just affect fuel, it pushes on transport costs, agriculture, manufacturing, and eventually consumer prices. In other words, regional conflict can amplify inflationary pressure, but it does so through transmission mechanisms we can actually analyze, not through vague theories of deliberate concealment. The same need for precision applies to the US dollar. The dollar's global reserve role creates genuine structural advantages for the United States. Those advantages include lower borrowing costs, strong international demand for dollar-denominated assets, and lower exchange rate risk for US institutions and businesses. Economists often refer to part of this advantage as seigniorage. But this is not best understood as an intentional wealth extraction scheme. It is a feature of network effects, deep capital markets, and institutional trust built over decades. When inflation rises globally, it is analytically weak to blame dollar policy alone. Inflation emerges from multiple forces interacting at once: supply chain normalization, fiscal expansion, labor market tightness, commodity volatility, and shifts in credit conditions. Gold also deserves a more disciplined interpretation. Gold is often presented as an immediate hedge against inflation, but its actual role is more strategic than tactical. In the short run, gold does not always move tightly with consumer price data. Over longer periods, however, it tends to maintain a stronger relationship with broad money supply expansion and the preservation of purchasing power. That means gold can function as a multi-year anchor, especially when used alongside inflation-linked bonds, real assets, and selective commodity exposure. It is not a perfect timer. It is part of a resilient architecture. Now let's look at how the global system itself is evolving. What we are witnessing is not a clean fracture into isolated blocks. Instead, the international financial system is developing layered redundancy. Capital flows, trade settlement patterns, and central bank reserves are being reorganized in response to shifting risk and reward. Three interrelated clusters are becoming more visible. First, the US dollar liquidity core remains dominant. It still anchors deep market access, cross-border settlement, and crisis liquidity. The network effects behind the dollar remain powerful, and institutional inertia matters. Even if its relative share gradually declines, its central role does not disappear overnight. Second, commodity-backed reserve networks are gaining relevance. Gold accumulation is increasing. Energy-exporting sovereign wealth structures are expanding. Bilateral resource for infrastructure arrangements are becoming more important in some corridors. These networks often prioritize store of value stability and sanctions resilience, rather than pure yield maximization. Third, regional trade settlement blocks are advancing. Across parts of Asia, Europe, and the Gulf, we see greater use of local currency invoicing, regional clearing mechanisms, and more interoperable payment rails. Adoption here is being driven less by ideology and more by trade intensity, supply chain centrality, and the desire to reduce friction. This transition matters because currency systems tend to move in non-linear ways. For long periods, dominant networks appear immovable. Then, when alternatives become sufficiently usable and trusted, behavior changes more quickly. Corporate hedging strategies adapt. Central banks adjust reserve allocations. Trade contracts begin to reflect new realities. The key point is that we are not seeing a sudden rupture. We are seeing a threshold-dependent reallocation. So what might the next decade look like? A useful framework is to think in 3 phases. Phase 1 is adaptive rebalancing, from 2026 through 2029. During this period, the dollar likely remains dominant, but its share in commodity trade gradually settles lower. Central banks continue accumulating gold. Policymakers focus on managing volatility, anchoring inflation expectations, and preventing liquidity mismatches, especially in emerging markets. Phase 2 is structural reconfiguration, from 2030 through 2033. Here, multi-currency invoicing could gain more institutional acceptance. Commodity-linked settlement instruments may mature. Regional clearing systems become more robust, and interoperability standards matter more as policymakers try to prevent fragmentation. Phase 3 is the emergence of a new equilibrium, from 2034 through 2036. In that world, the dollar still retains primacy in deep liquidity and financial markets, but gold and commodity-linked instruments play a more visible role as long-term store of value anchors, while regional currencies handle a larger share of localized trade settlement. Inflation volatility may remain somewhat above old baselines, but still within ranges policymakers can manage. In short, the likely outcome is not the end of the current system. It is the construction of a more layered one. Of course, transitions are never risk-free. The downside risks are asymmetric. Tail events may remain low probability, but their effects can be severe. Sovereign debt stress is one concern. When interest payments absorb too much government revenue, rollover pressure intensifies. Energy supply shocks are another. A major disruption near critical transit routes, especially when buffers are already thin, can sharply amplify commodity volatility. Trust erosion also matters. The overuse of financial sanctions, poor reserve transparency, or abrupt capital controls can accelerate diversification away from incumbent systems faster than policymakers expect. And then there is policy credibility. If core inflation stays too high for too long, while real interest rates remain deeply negative, expectations can become harder and more expensive to re-anchor. This is why serious observers should track measurable warning indicators rather than emotionally charged narratives. Among the most important signals are the share of oil trade still invoiced in US dollars, the pace of central bank gold purchases, the ratio of US interest payments to government revenue, the persistence of core inflation above 4%, the depth and duration of negative real policy rates across major economies, and whether sanction frequency materially accelerates beyond historical norms. These indicators do not predict regime shifts with certainty, but they help identify when balancing mechanisms are weakening and when reinforcing dynamics are starting to dominate. So how should households, companies, and institutions respond? For households and retail investors, the central principle is balance without extremism. Maintain strategic exposure to gold and real assets as long-term purchasing power anchors. Diversify currency exposure where practical. Avoid all-or-nothing bets on either currency collapse or permanent dominance. Focus instead on inflation-adjusted returns, cash flow resilience, and liquidity buffers that can withstand volatility. For corporate treasurers and finance leaders, the lesson is to move beyond pure efficiency and toward controlled redundancy. Build multi-currency settlement capacity. Stress test supply chains against commodity and foreign exchange volatility. Maintain complementary banking relationships. Diversify invoicing where it makes strategic sense. Design capital structures that can absorb higher rates, funding stress, and payment friction. For policymakers and institutions, transparency and coordination are essential. Better reporting on reserve composition and settlement trends can reduce speculation and overshoot. Stronger stabilizers for commodity volatility, multilateral liquidity backstops, and credible institutional frameworks all matter. In a transition environment, trust becomes a strategic asset. And across all of these groups, one idea stands out above the rest. Redundancy outperforms optimization during periods of structural change. Systems built for maximum efficiency often prove fragile when the environment shifts. Systems built with modular flexibility, liquidity buffers, and optional pathways are better positioned to adapt. The conclusion is straightforward. The global financial architecture is not collapsing. It is reorganizing. Geopolitical friction, monetary expansion, reserve diversification, and settlement innovation are interacting to produce a gradual but meaningful shift toward a multipolar and still interconnected system. This transition is likely to be managed through market adaptation, institutional learning, and policy calibration rather than sudden regime change. In an era defined by overlapping shocks and changing monetary norms, resilience comes from flexibility, diversified positioning, and close monitoring of leading indicators. The future will likely reward those who avoid simplistic narratives and instead design portfolios, supply chains, and policy frameworks capable of performing across multiple possible outcomes. If you found this episode valuable, please like, share, and subscribe to the XFO Intelligence podcast channel. And for feedback, ideas, or collaboration inquiries, email xfointelligence@gmail.com. Thanks for listening.